Today, we're looking at something a little different. We have two companies that have proposed to merge together. The boards of directors and shareholders of both companies are in favor of the deal. However, the Federal Trade Commission is now suing the companies to block the merger from completing. This means there is an unusual risk profile to this deal, and that is reflected in the share price. An investor, if they are confident the deal will close, could reap a huge return from an investment. However, should the deal fail to close, such an investor would face a significant loss. The question we are asking today is, has the market correctly priced the risk present in this transaction? If the market has overpriced the risk, there is the possibility of a huge financial return for the daring investor. However, if the market has underpriced the risk, such an investor will face a significant loss. I hope you find the analysis and discussion in this video useful, and if you do, I would be grateful if you would give a like in return. So, this saga began in August 2023 when Tapestry made an all-cash offer of $57 per share to acquire Capri Holdings. Tapestry began life in 1941 as Coach New York, specializing in handbags, luggage, and accessories. The company proved successful and in 2015 purchased Stuart Weitzman, the shoe designer, for $574 million. Then, in 2017, Kate Spade New York was added to the stable for $2.4 billion. Kate Spade New York also had its start in handbags, but expanded its range to include personal organizers, address books, shoes, beauty products, perfume, and clothing. The enlarged group was renamed from Coach New York to Tapestry and now boasts annual revenue of $6.6 billion and a market capitalization of approximately $10 billion. Capri Holdings, formerly known as Michael Kors, is a fashion retailer which was incorporated in 1981 and has also had its share of mergers and acquisitions over the years. The company purchased Jimmy Choo, the shoe designer, in 2017 for $897 million, followed up with the purchase of Versus, the Italian fashion group, for $2.1 billion in 2018. It was at this time the company changed its name from Michael Kors to Capri Holdings. The company now boasts revenue of $5.1 billion and a market capitalization of $4.5 billion. When Tapestry made its friendly takeover offer of $57 in August last year, the shares of Capri were trading at $35.50, but they quickly jumped to $54.50 in anticipation of a quick and easy transaction. However, by April 2024, the Federal Trade Commission had initiated legal proceedings to prevent the transaction from completing. This move by the governments sent the shares sliding to as low as $30.44 by August, a full $5 lower than they were trading at before the deal was announced. The Federal Trade Commission believes the proposed merger will reduce competition, particularly between three of the group's brands, Coach, Kate Spade, and Michael Kors. Further, the FTC argues Tapestry would gain a dominant share of the accessible luxury handbag market. Both Tapestry and Capri have announced publicly that they intend to defend the merger and will fight the FTC through the courts, and they have unexpected support on their side. The Partnership for New York City is lobbying senators and member of the House of Representatives to denounce the FTC lawsuit. Finally, given the pending U.S. elections, there are questions as to what will happen to FTC Chair Lina Khan and the Department of Justice's Jonathan Kanter, both of whom have fought aggressively against corporate consolidation, and both of whom may or may not be replaced after the election. So, as you can tell, this is a deal that has more moving parts than most and a risk profile not seen in many friendly mergers. As we discussed, the share price of Capri was $35.50 at the time of the announcement, before falling to $30.44 in August this year, and currently stands at $36. The takeover price is a fixed value of $57 in cash. The original goal was to complete the transaction during 2024. However, given the FTC suit, we have estimated a completion date of February 2025 in our calculations. The big question with this deal is, what is the probability that it will actually close? So that we can see how the probability of closing affects an investor's expected return, we have run two scenarios. The first assumes a 75% chance of the deal closing, and the second assumes only a 25% chance of success. All other details of the deal remain the same, neither purchase and sales prices, the duration of holding, and a downside price, should the deal fail to close, of $25. We can see, assuming a 75% chance of success, an investor can expect a return of 58.2%, which translates to an annual return of 120.02%. The risk-adjusted return here is 74.23%, and the expected loss, should the deal fail to close, is 30.61%. These numbers are all favorable to taking a long position in Capri. The return is high, and the even money probability is lower than the probability of closing at 34.95%. However, when we move to the second scenario, assuming a 25% chance of the deal closing, the expected return remains at 58.2%, as is the annual return at 120.02%. However, the risk-adjusted return is now negative 17.34%. The expected loss, should the deal fail, remains the same at 30.61%. The even money probability also falls below the probability of closing. The important difference here is the risk-adjusted return, which falls from positive 74.23% to negative 17.34%, a spread of 91.57%. For the uninitiated, we calculate the risk-adjusted return by multiplying the probability of the deal closing 75% here by the expected profit, $20.97. We then add the probability of the deal failing 25%, multiplied by the expected loss, $11.03. We then divide this by the cost of the investment, $36.03, and then work out the annual rate by multiplying the duration of holding, 177 days, dividend by 365. This starting difference in the expected return for an investor is driven solely by the probability that the deal will close, and this is why it's such a crucial consideration for all arbitrageurs. Without knowing the risk, you can't intelligently calculate the likely return, and therefore you can't compare one possible investment to all of the others that are available to you at the same time. However, what if we now consider a scenario where we truly believe the probability of the deal closing is only 25%? Does that mean there is no intelligent investment here? Actually, no. If we determine that we need a minimum risk-adjusted return of 15% to make a deal attractive for us, and we keep the other parameters the same, offer price, holding period, and downside price, the one variable left is the purchase price. We can run a simple quadratic equation to determine what purchase price would yield a 15% risk-adjusted return. In this instance, a purchase price of $30.76 results in an expected return of 85.3%, which translates to an annual return of 175.89%, and a risk-adjusted return of 15.01%. This yields an even money probability of 18.22% against an expected 25% probability of completion. This is a deal that most arbitrageurs would take, depending on the alternatives available at that time. This may seem well in theory, but we have already noted the price per share was $35.50 before the takeover approach, then quickly jumped to $54.50, and now stands at $36. However, as we discussed in a recent video about Hawaiian Airlines takeover by Alaskan Airlines, linked to that video below, the longer a deal lingers, the higher the probability that the share price will decline as investors take profit and cycle their capital into alternative opportunities. This has also been the case with Capri. The share price has steadily declined from $54.50 last August to a low of $30.44 in August 2024. It would therefore have been possible to commit to the deal below the target price of $30.76, with only a 25% probability of the deal closing, and have a favorable outcome expectation. As we have discussed before, this type of arbitrage requires more attention and active monitoring from the investor, but the expected returns, should the deal close, can be spectacular. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.